Okie dokie. P4-1 is a great review of the three basic financial statements. The income statement covers a period of time. Did we make money? Did we lose money? The statement of retained earnings says if we made money, what did we do with it? Did we keep it in the business or did we return it to our shareholders in the form of dividends? And the balance sheet says at a moment in time, say the last day of the year, how much cash did we have in the bank? How many accounts receivable were we owed? In other words, what did we own versus what do we owe? What were our debts at year end? The difference between what we own, our assets, and what we owe, our liabilities, is our equity in the business. So this problem asks us to create a multi-step income statement, which means we're going to strike subtotals as we go down. And hopefully you noticed that they were kind enough to put all the expense accounts for us over here on the right hand side and pretty much in the order that we're going to need them. And the left hand side are our balance sheet accounts. And hopefully you remember that an account appears either on an income statement or the balance sheet, not both. So let's start with the income statement. This is our gross sales of $3,625,000. We subtract from that our dissatisfied customers. We call those sales returns and allowances, minus our sales discounts to give us our net sales. And since this company is a merchandising company, in other words, since it sells things, the biggest expense it's going to have is the cost of those things. So we subtract that first, cost of merchandise sold or cost of goods sold. In other words, we sold a bunch of things, they cost us $2,175,000, but we sold them for more than that, $3,567,000. So our markup, our gross profit, is $1,392,000. Then we have to subtract our operating expenses. Accounting books love to break things down into selling expenses and administrative expenses. I usually see them lumped together as selling, general, and administrative expenses as one total. So like I said, they put all these expenses in order for us. We've got sales salaries, advertising, depreciation expense, and miscellaneous selling expense. We've got office salaries expense, rent, insurance, depreciation expense on the office equipment, supplies expense, and miscellaneous administrative expense. And so our total operating expenses are $605,000. This would probably look better if these were over a little bit, these two, and then you'd have this total out here for $605,000. So we subtract that $605,000 from this $1,392,000. And we get income from operation of $787,000. So this is the money we make in our business. But there's other revenue and gains, other expenses and losses, things that aren't related to our core business. This problem has only one of those, and that's interest expense. We subtract that $12,000 interest expense from our income from operations, and we end up with net income of $775,000. We know that's right, because the book was kind enough to give us that answer. My students will recognize that I always write the income statement in red and the statement of retained earnings in blue to help you make the distinction between the various financial statements. I suggest my students memorize retained earnings at the beginning, which in this case is $253,800, plus net income, we just figured out what that was, minus dividends, that tells us that's $125,000, gives us retained earnings at the end. So memorize, if you would, retained earnings at the beginning, plus net income, minus dividends, gives us retained earnings at the end. And that's the number we're going to use on our balance sheet. The book asks us to create the balance sheet in report form, which means assets on the top and liabilities known as equity on the bottom, but I'm going to do it this other way. I'm going to do it in account form. On the left-hand side are things that we own. Cash, accounts receivable, office supplies, prepaid insurance, inventory, for total current assets of $640,500. Our office equipment, we originally paid $115,200 for it, but we've used up part of that. We spread that cost out over its estimated useful life, so we subtract $49,500 of accumulated depreciation. I suggest my students memorize the journal entry for depreciation expenses. Debit depreciation expense, credit accumulated depreciation. Depreciation expense appears on the income statement. Accumulated depreciation is a contra asset account. We subtract it from our original cost of our fixed assets. Same thing for store equipment down here. Store equipment, it tells us that we originally paid $511,500 for it. We've used up about 40% of it or so. So we've got $186,700 of accumulated depreciation. This minus this gives us this. We add up all our assets and we get $1,031,000. If we have $1,031,000 on the left-hand side of the balance sheet, we should have $1,031,000 on the right-hand side of the balance sheet. My students will also recognize that I try to write my equity accounts in blue so that students get the notion that there are two kinds of accounts on the right-hand side. Liability accounts at the top and owner's equity at the bottom. Any account that has the word payable in it, any account that has the word accrued in it, any account that has the word unearned in it has to be a liability account. So that means it appears up here on the upper right-hand side of the balance sheet. We've also got a note payable with a total of $54,000, but $8,000 of that is due next year. Anything that's due within the next year is called current. So we have the current portion of that note payable there. The balance of it, that's $54,000 minus $8,000 is $46,000. That must be the long-term portion of the note payable. And then down here, like I say, we stick our equity accounts. Capital stock, that's the money that the shareholders paid into us. Retained earnings are earnings that we have made on their behalf and retained in our business rather than paying out. And you recognize that 903,800 from just a couple seconds ago. So hopefully problem 4-1 is a great reminder that an income statement covers a period of time. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And the balance sheet has what we own on the left-hand side, what we owe on the right-hand side, and the difference between what we own and what we owe is our equity, and that's in the lower right-hand portion of the balance sheet. All right, I hope this helps. See you guys.